With the election a little over a month away and the first presidential debate in the books, the New York Times reports that investors see uncertainty and they don't like it. One interesting quote here in this article jumped out at me, and I'll read it to you right now. We're seeing the markets price in potentially greater risk for the period after the election than they are for Election Day, said Steve Sosnick, chief strategist at Interactive Brokers. I can't remember a time where U.S. citizens had to worry about whether there would be a peaceful transfer of power and whether all parties would have any doubt in accepting the electoral results. A common theme here is observers are less concerned about who wins the election than they are about the election being decisively won. So we don't have weeks or potentially longer uncertainty leading to potentially something worse. So let's look at a way you can limit the risk to your portfolio if you're long. Let's say you're long a tech-heavy portfolio. Let's look at a way to hedge market risk using the NASDAQ ETF QQQ. So the first thing we'll do is we'll look up the current share price of that ETF. And as of Wednesday's close, that was $277.84 per share. Now, let's say you have a $500,000 portfolio. First thing you would do is divide $500,000 by 277.84. And that gets us 1,799. We'll round it up to 1,800 shares. The next thing you do, you open up the Portfolio Armor iPhone app and you enter in the symbol QQQ. For the Invesco QQQ Trust, which tracks the NASDAQ 100, and then you enter in the number of shares we calculated that corresponds to $500,000. The next step is to decide how much risk you're willing to take. So, in general, the more risk you're willing to take, the less expensive it will be to hedge. You could, but this really depends on your risk tolerance. So for this example, let's say we'll pick 21%, okay? And then after that, we want to pick how far we're hedging out to. So since we're concerned about election risk, and we're not sure, the election is on November 3rd, but we're not quite sure it's going to be resolved by then, maybe we'll check the November 20th expiration date. And we tap Find Optimal Hedge. And there you go. This is the optimal hedge to protect against a greater than 21% decline in 1,800 shares of QQQ by November 20th. And as you can see, the cost here is not that expensive. It's $3,492, calculated conservatively, assuming you bought the puts at the ask. In practice, you can often buy them at some price between the bid and ask, so that's conservative. And that cost as a percentage of position value was 0.7%. So if you can only tolerate a decline of 21% between now and late November, this may be the way to go to protect yourself against a larger decline in the event of political risk. And of course, if you have less of risk tolerance, you could just go back and enter in another figure here. You could put in 15% or 10%, whatever you like, and you'll be presented with the optimal hedge in that case. But as you can see here, the cost as a percentage of position value is 1.49%. So the lower the decline you're willing to risk, the smaller the decline you're willing to risk, the more expensive it'll be to hedge. But in general, it's not terribly expensive to hedge market risk here. So for risk-averse investors concerned about political risk, you ought to take a look at this.